And Todd, you mentioned that you're seeing a lot of flows into equal-weighted S&P funds. Is that kind of driven, you think, by this concentration risk that everyone is talking about, and that's a way to kind of garner more exposure to a diversified basket of stocks?
Yeah, it's hard to see NVIDIA at 8% of the S&P 500, Microsoft not far behind at 7%, and not get concerned about how concentrated you are with an ETF like SPY or Vanguard 500 VOO. So people are looking to get the benefits of diversification. You can do that through an equally weighted approach that we talked about. You can also take advantage of the growing number of actively managed ETFs that have come to market. So stocks will be inside the portfolio because management has confidence that there's still more room to go. So we've seen firms like T. Rowe Price or Capital Group or Fidelity have a lot of success with actively managed equity ETFs. You might still find NVIDIA and Microsoft within the portfolio, but there's a expert manager who's there who's made that decision instead of it just running up because it's the largest company within the overall market.
And Bruce, do you think that having a more diversified basket serves essentially as a hedge to that concentration risk? Is that a good way to protect against such a run up in individual names?
Absolutely. So what Todd mentioned, I'm going to have to do a little plug for our solution to the over concentration risk, which is an ETF called, the ticker is ROE. It's our Quality Kings. And so we launched this because we were building ETF portfolios. We got very concerned about the overweight, but we didn't like the fact that the equal weight 500, when you invest in it, you become extremely underweight tech, maybe 15% versus 35 for the benchmark. So we created a quality screened universe, and then we choose from that universe and we equal weight 100 names. And we make sure to match the sector weights of the S&P. So if the S&P is 35%, we're 35%. And that's been a very strong strategy for us and has done very well against the traditional equal weighted. And so generally, just to your question about the over concentration, history is littered with the companies that were riding high way back to Kodak, IBM, GE, Lucent, Cisco, on and on. And so what we would tell advisors, their clients are often giddy right now because of what's happened with NVIDIA and Microsoft and others. But we would say, hey, if there's a chance to, prune these things back without taking taxes, you should take a hard look at the 351.
Yeah, they don't want to put all their eggs in one ETF basket. It makes sense. Todd, the S&P 500 Momentum Index is up more than 34% this year. What's behind the interest in momentum right now? Is this just part of the overall kind of risk on sentiment that we're seeing in the broader markets?
So this is the opposite of what we were just talking about, of reducing your concentration. A momentum strategy is letting your winners run. And so there's an ETF from Invesco, SPMO, that gives you exposure to the stocks that have the strongest relative strength, part of the S&P 500, the 100 largest of those, or companies that have the best relative strength. And it's been outperforming the broader S&P 500 this year, as well as on a rolling 12-month basis. What's interesting is that it's not just technology stocks. That's what I would have thought would have been the case, that and consumer discretionary.
It's Kohl's and
it's actually, yeah.
American Eagle. And
we're seeing those companies. We're also seeing financials and consumer staples. So Walmart and Costco, JP Morgan, these are stocks that are also within the portfolio. I think we're showing on the screen another ETF, MTUM, which is the iShares version of momentum strategies. It's rebalanced at a different period of time. It's a different universe. It's not exactly constructed the same, so thus it doesn't perform exactly the same. So it's really important when you're looking at a momentum ETF or any of these other ETFs to make sure that what you get inside the portfolio is what you think you're getting inside. If you want more technology, make sure that portfolio has more technology.
Do momentum ETFs tend to outperform over the long run? I ask because, there's the adage, past performance not indicative of future results. So here you have an ETF that literally is about the past performance being great. It has done well this year. Does it tend to do well kind of empirically over a longer horizon?
Yeah, so momentum is one of those factors that has historically outperformed the broader marketplace. We've seen quality companies. We were just talking about a quality ETF, and there's a bunch of those that are out there from a number of different providers. Value strategies tend to outperform, but momentum is one of those areas. So MTUM and SPMO are good ways to get exposure to that trend.
Yeah, because momentum works both ways as well. Bruce, any last thoughts from you?
There's a lot of great tools out there in the market, and I think it's worth investors doing their homework to find out about them. 351 is certainly one of those. If you visit us at AstoriaAdvisors.com, there's lots of information, and we'd love to talk to you.
All right, wonderful. Well, my thank you to Bruce Lavine of Astoria Portfolio Advisors, Todd Rosenbluth of VettaFi. You can catch our shows and all our other content at etfedge.cnbc.com. Thank you for watching.